Well, guys, what we've been talking about recently has been happening. Volatility is spiking, and Nvidia just lost AMD's entire market capitalization in one day. That, along with Bitcoin halving, is coming up in today's special weekender report of stocks, commodities, and cryptos together. But also, what was happening underneath the hood on the Friday trade for the S&P 500. The results might surprise you as we reach mean reversion in these markets. With the VIX, Nvidia, and of course central bank liquidity in focus, there's a lot to discuss for the week ahead. Well, welcome back everyone to the special weekend edition of The Daily Show. My name is Tom. Today we're discussing the macro, the data, and everything else that matters to you, whether you're an investor or trader. Make sure to join us throughout today's show because there's a lot to go through. Let's begin with semiconductors, and of course Nvidia was down over 10%, SMCI was down over 20%, and Nvidia ended up losing more market cap in one day than AMD's in total size. That's pretty wild, and I think this week is just going to get even wilder. So make sure to subscribe and hit that bell because we're bringing you everything to do with the earnings kickoff of major big tech. So let's talk a little bit about corrections because, of course, when they happen, nobody usually wants to buy them. And that's the thing, expectations versus reality. Just a normal correction always will feel entirely different when it hits you. Now, this is an important quote because you have to have a steadfast resolution of what you're going to do next. And I think one of the things that was really interesting underneath the hood on the Friday session was that you might think everything was selling across the board. It really wasn't. Semis were down, but the rest of the market actually upticked a little bit throughout this session, bringing breadth back in at the most important first gap fill of mean reversion. Now, if you've been watching the channel for a while, you would know that this is our biggest first bull level, and then the second biggest bull level sits down here, also at the 50-week moving average. So these particular levels will matter, and I think that considering some of the data you might see today, you might be changed in terms of what you're looking for on the charts. Also, did you know that if you took from the year to now, T-bills just overtook, yes, they just overtook the NASDAQ in terms of performance. From January of 24 to now, things have changed in a big way, going from plus 9% all the way back down to only being up 1.5%. So you basically wiped off the first 4 months of the year so far. Also, do we see an oversell in the market? Well, some core risk models, such as the one here from Macro Charts, is showing that it's a little bit oversold. And I would tend to agree. In terms of flash selling here, we are seeing signs of similar kinds of sell-offs that we've had in the past that have generally been bought up or at least dead cat bounced. Now, because of the way market closed, which we'll go through in the charts a little bit later on, we're going to have to be very, very careful of what we're seeing here. But we did just enter into an oversold market by quite a few metrics. Another metric would be this one here from the McClellan AD oscillator. You'll notice again, while we're selling off, the actual market itself is kind of improving underneath the hood. And this is because it's a rotation out of semiconductors. So let's take a step back and have a quick look at semiconductors now, because this is pretty wild. As we bought up in March, we expected that April would not be a good month from a semiconductor standpoint. Over the last 10 years, they've only been up 30% of the time. Now, does that change in May? Well, it does. It turns out the start of May brings with it the bull generally for semiconductors. 90% of the time, semiconductors have been up during the month of May, and it's actually one of the strongest months of the year for the markets in terms of semis. The second strongest generally being November, the first being this May period. Now, why could that be? Well, a lot of it has to do with earnings coming up as well, and where we tend to kick off with usually pretty good results coming out of semis. But I do think that there's another chart we should be considering. This one here, which is from the Bank of America, and it shows here that their research estimates that we're in another fairly decent bull run here for AI, or in this case, semiconductor stocks. In fact, their forecast is actually pretty good all the way to 2026, where they're starting to see potentially a little bit of a drop-off. And this has actually happened before. We've seen 4 quarters of sell-off a few times, 5 quarters in 2022 into 23, and then we start to see the potential of a pretty good forecast moving forward into at least 2025. Now, does this mean we should be buying the dip? Well, let's take a look at some stats here from Wayne, because of course Wayne always goes through and he finds relevant stats for similar periods in time. Well, as it turns out, when we have a bad month, which is the 6th month being April, and it ends up closing in the negative territory, currently sitting at negative 5.46, the results were actually pretty favorable when we take a look at the next 6 months. And as you know, we've been very fixated on this 6-month statistic, with many reads coming to the point where sell-offs here should be theoretically bought up over the next 6 months coming into the election year. 27 and 3, so that's 27 positive to 3 down over that period of time. So a lot of people will then say, well, is the market cheap? Is it actually back to a really good price yet? Well, based on the forward PE ratios, which you know I like to use and we all do here, we're not quite back to anything that looks very fantastic. 5-year average forward PE usually sits at an average at the moment at 19.1, and 10-year average is obviously much lower than that, 17.8. Now, if you ever can get less than 17, that's usually a pretty smiley face time on the markets. But at this point, we're getting closer and closer to that 19.1, which is the average point. Is it expensive? Yeah, it's pretty much the average. So therefore, that's where you would expect the markets to be fairly well priced. Now, we're just above that. We're much better than where we were a few weeks ago at 21. So things are starting to improve for the investor and particularly even for the trader in terms of getting a longer term swing position in if markets do turn towards the upside. Let's have a look at where the sentiment has actually shifted. Now, generally during most sell-offs in markets, you want to see the sentiment go from being an overall bullish sentiment to an overall bearish sentiment. That tends to be where sentiment reports work the best. And you'll notice that often when you come out of a sell-off level, you often come in with that huge bearish sentiment for quite some time, where you climb what we call the wall of worry, or the wow. Now, in this case, we've had very bullish sentiment recently, and we're looking for that to drop off negatively. Now, most of these reports are taken as of Tuesday, so by the time we get them, it's usually later on in the week. I would estimate that we're probably going to go to a red here in terms of sentiment reports next week, just because it will be quite bad based on what's happened to the semiconductors in particular. Now, you'll hear us talk a lot about 6-month stats. This is just another one for you. Last week, we saw many consecutive days where we opened bullish, kind of like Friday, and then we actually ended up in the red. Now, when you see this, you are in for 1 month of potentially pretty large volatility. So volatility tends to spike, and we've been talking about this for a while. But remember, the stats are quite favorable over the next 3 months and 6 months when it comes to these circumstances. We've got some other big data coming up in today's show, but let's have a look at the S&P 500 and break down the charts for the week ahead. So in particular, we have 2 main levels. Of course, we've got the one that we just find ourselves at right now, a major gap fill. So that's pretty successful. A close on the low, which definitely is interesting because that signifies that bears were in control near to the end of the session. And we've also got the potential of mean reversion holding up this market. Now, if you haven't looked at 20 hits before, you might notice that in general, they are usually purchased up. And in fact, in most bull runs, the 20 moving average is at least finding some buying pressure at the beginning. And even when it goes to the 50, you'll notice the 20 often does end up finding a buyer, and then it comes back down to the 50 later on. Here's the 20 touch, it comes back down to the 50 later on. So even if we are going to get a worse sell-off, in general, with the metrics that we're coming in with right now, you would expect some buyer to try to commit themselves to this price at this point. Whereas some other levels that I think are interesting, of course, the 4,700 to 4,800 level is really quite spectacular on this chart because it will also hit in with the 50 moving average. And it's very rare to get more than that. It's also very rare to get more than a 10% correction on the S&P 500 over the last kind of 15 to 20 years. In most times, you usually get between a 5 and a 10% correction. So 10 is usually about as bad as it gets during what we've already had, which is a fairly decent breadth market. And again, this is really where that first kind of sign comes through. So stick with us because we're going through some of the other key levels, including the options right now. So one of the big things was that we're continuing to be in a negative gamma situation. And you'll notice here over the Friday session, we ended up doing the exact same thing we've done every single time. In our Market Masters Club, I discussed this as being the only real possible main trade throughout the Friday session, which was to fade the rally that came in. And one of the key reasons why I wanted to fade that rally was this, the 61.8 fib, which we've seen every single time the major kind of pickups have happened after the market sells off after hours, end up effectively being the sell point. In fact, the 61.8 has already happened 4 times over here. So which levels should we be watching for the week ahead? Well, let's get rid of this particular Fibonacci and take a look at where we closed. We closed at 49.63, just underneath the weekly 20 moving average, but more importantly, right around the bull level number 2, which is sitting between 49.75 and 49.80. And it also just happens to be a major put support. It also seems that the market is selling off on a 20 moving average now. And you'll notice that on the 2 hour here, this is actually a very important level to see broken from the bull side. If we do sell off in the morning and then rally through this point, I would say it is very likely that the bulls are in control for that period of time. And at this point, the bears probably won't really want to be selling this market off until we get into that 50-40, 50-50 zone, because this is where we've seen that minuscule supply that went through as the market churned through Wednesday and Thursday of last week. So it's a pretty decent sell-off. On the dailies, you can see here that it's not actually a close on the low when you look at the futures market. We're getting a number 7 read, which basically means that we're getting exhausted on the sell side. Volume is through the roof because, of course, there's a lot of fear in the markets. And we're kind of in the point now where bulls really need to show that they mean business if they're going to stop this potential sell-off. Now, if it does end up rallying and we see further weakness and we come back down, the chances of going to 4,700, 4,800 become quite big. And what we'll be looking for is in particular what semiconductors are doing. The most important thing is really what semis are doing, as semiconductors also have hit a critical level of support, which we'll look at later on in today's video. So let's break down the options. Why do we say this is such an important zone for the bulls to hold? Well, just like on the Friday, there's a lot of negative gamma, and we seem to be sitting right on the price of the major put wall. Now, if we end up holding underneath 49.75 throughout the Monday, there's a chance that basically we'll have to be seeing selling of futures by people needing to hedge off this large position strike. That'll then force kind of further selling in the markets and potentially force a very quick reprice to something like a 4,800, 4,700, just because of the flash sell nature of everyone trying to short vol right now. But this is a very important point. So will we see the market structure hold up? Well, it seems to be the problem for the rest of the week as well. You can see here on the 22nd expiration, which is the Tuesday, we also have a whole bunch of puts sitting between 49, kind of 60, all the way to around 50.25. So the market chopping around this zone would actually be quite profitable from most of the options riders out there, and they may want to try to hold it here if they can, or at least see some kind of rally. Have we seen the CTAs change their game yet? No. And generally, this is also a good read that a rally is coming back in. CTAs, or commodity trade advisors, if you haven't seen them before, often tell us when markets are starting to get a little bit weakened. And we saw this up here with the NASDAQ, which first alerted us to a problem. We obviously saw them break below while we were rallying in the market, and it showed us that this correction was more than likely going to happen. But whether a 10% happens or not really depends on whether they keep dumping the position. And you'll notice here the SPX has already started to accelerate in terms of their overall selling. So again, if they keep selling and we're rallying, so a good case would be, let's say the market is rallying and SPX, let's say CTAs are still dumping their positions across the board, it probably tells us it's a false rally. And this is something we'll be looking for throughout the week into earnings to see whether any rallies are actually fake. Are we in a stock market correction? Well, in many ways, the stats still say yes. Of course, the percentage of S&P 500 stocks above the 50-day, that's not looking very good, and that's dropped down. That's actually expected, though. Usually these kind of oversold markets are fine. The core market models, they usually look pretty good right now. Leadership obviously is not coming with us at this stage, and risk-off, risk-on indicators still remain in the general risk-on across the higher timeframes. So it's not time to panic yet in markets, and as you can see here, from extreme overbought all the way into oversold, still takes some time. I think something that's worth noting, though, is on this particular model anyway, different from the core model that we saw before, we do usually mostly hit that zero line or just underneath. We don't have to extreme oversell to see bounces in this particular market. And that's because it's not designed to show extreme oversolds and overboughts. Instead, it's really designed to say, can you hold a position through a pretty bullish market? So if you think about it, when you've had these kind of pullbacks here in what looks like a pretty good breadth market, you don't usually get extreme oversolds until something really goes wrong. And that's why it's really more better to use it around the 0 to 0.2 kind of ratio from the buy area. Let's now have a look at whether this is normal in election years. Well, as it turns out, yeah, it's pretty normal to see a correction around 10%, 5 to 10%. Actually happens more often than you think during election years. And when we have a huge election start, it's actually pretty normal when you track huge election starts, which there's not too many data points for, to see sell-offs that can end up in May. Now, remember, semiconductors are running this market right now. So if we tend to have that weakness that kind of goes through potentially into the start of May, again, price action willing, that could make a lot of sense for this type of pullback in time or correction period. And that we do usually see an incredibly good run after that. So I think that's an important factor when you're looking at these markets. When you overlay all of the different ones, the same kind of story comes up. You'll notice here all markets overlaid with each other with 0.93 correlations. We expected pullbacks at this time, then we expect generally rallies. The most important thing here is to think about the 6 months more than anything else. And even when you look at all election years together, you'll notice that these ones that are most bullish, which of course we've been talking about, 2012 and 1976, in both cases, this is where the stat comes from. The weakness into strength tends to be there. So yeah, it's pretty normal to see this sell-off right now. And you might say, well, it's the tensions in the Middle East, it's interest rates being high, which have been high for a while now, so the higher for longer is there. Really what will derail this potential bull run, in my opinion anyway, and we'll let us know what you think might be derailing it in the comments down below, is probably going to be earnings. If forward guidance comes in really bad across most tech, of course, Netflix not looking too good at this stage when they're saying we're not going to give you any of our data on subscriber additions anymore. If that continues to happen, then I think we could be in for a little bit of trouble. But let's have a look here at the S&P 500 overall bull run. Generally speaking, we are in an overall decent cycle. And this cycle should go, I mean, they say into the 2030s. My opinion is 2026 into 27 is very possible. I've mentioned this quite a few times in our live stream over the years. And there are a few reasons why I believe that is. Mostly to do with debt and trying to hold broken things in the markets, such as the Federal Reserve is doing, as long as possible until it ends up exploding across the board. Also, is it pretty normal for us to see sell-offs around this time? Again, yes, I think it is. It's pretty normal to see pullbacks. This is a little bit outdated now, so we'd be about here at the time of recording. And this is really just showing you again, though, that these pullbacks, these corrections, could be actually decent buying opportunities. We've got some dark pool data as well coming up soon that'll show you, in particular with the semiconductors, most likely someone actually closed some of their profits. What about healthcare? Is that a good area to be looking at? Well, it's pretty oversold. And again, when you get these types of oversells, the stats are very favorable a year later. It's not the kind of movement that you see in a semiconductor, but still looks pretty bullish. And from this earnings season kickoff, S&P 500 percentage of buy, hold, and sell ratings continues to be pretty good. Buy ratings now making up 53.8% of the overall market. Hold is 40.6%. And sell only making up 5.7%. Now, if that increases, of course, when these ratings start changing, the market's already changing with it. But generally speaking, it does matter a little bit in terms of overall sentiment. Also, high yield bonds. We've been discussing these quite a few times. They've been dropping recently. We just saw outflows from high yield bonds the first time in a while. So outflows from high yield bonds, it's pretty normal, I guess, to expect this when the markets have been selling off. And then, of course, we're also seeing puts or put walls getting kind of wiped in the negative gamma situation. This is leading to futures selling and selling in general. So that's one of the reasons why that's occurring. Let's kick off earnings season though, guys, because this week is massive. And Elon Musk seems to be messaging quite a lot. It's almost like he's scrambling ahead of the earnings report. I don't know what that's going to look like, but sometimes a really bad earnings when markets are selling off anyway can be bullish. Think back to Meta of just a few years ago. Everyone was super negative on it, and that actually turned the ship. So I think Tesla will be interesting from the perspective of how the market reacts to it. I think it's going to be more of a patience, react, don't predict on Tesla unless you've got nerves of steel. But this is really a kickoff for not only smaller caps such as things like Enphase, but also we've got Meta, we've got Chipotle, we've got Alphabet, Google, we've got Microsoft, Roku, a lot of mid-tier, kind of lower-tier tech companies and the biggest ones in the world. So yeah, it's going to be a huge week of earnings. And let's just look at the anticipated moves on the options market. Tesla is going to be wild, guys. Plus minus over 10% is the expectation of the market for Tesla. Be careful out there, whichever direction you're on. It's going to be a pretty wild gapping, I think, either way. Meta also coming in with a plus minus 9%. When you consider how big that company is now, that's going to be $100 billion plus, hundreds of billions of dollars. So it's going to be a huge move. Google still showing up here with a 6 to 7% move. I mean, options is just absolutely wild this week on what it's expecting. And this is going to be one of those weeks that's going to have some of the biggest flow markets that we've ever seen. I mean, just because of the pure market capitalization size. So stay tuned for all of that stuff because it's going to get wild. Goldman Sachs forecasts for S&P 500 are actually looking a little bit better. In particular, I think the thing here is that rising CEO confidence suggests that firms will actually be deploying some of the cash in these funds across the board. Now, that's kind of good for the economy when you think about it. CEO confidence has just upticked above the 50% for the first time in a while. And while, it may not stay here for that long, CEO confidence can matter. And you'll notice that when it's kind of declining, especially if it's declining into something, then that usually means a recession is just around the corner. You'll notice they do tend to be kind of sneakies, particularly over here in the 2000s, particularly over here as well in the 1990s into the kind of bear period that happened around there. So what are we seeing right now? Well, we're actually seeing an uptick in CEO confidence. Now, if they start spending, and of course, we've already got these historical buybacks that are coming back on board, that's going to be a pretty big one. Also, Bitcoin halving. Yeah, well, celebration for, I guess, the Bitcoiners. I've been looking on X and everyone's making videos about how they're at parties with NFTs on the wall. I don't even know what's going on in terms of that stuff. But the one thing that usually does tend to happen after a halving is that we can see BTC's market dominance start to fade a little bit. Now, don't really care about this trend line here, but what I do like the look of is you can see BTC dominance actually declining. So this often brings with it altcoin season. Now, we haven't had an altcoin season for a while, but one of the stories that's floating around at the moment is Bitcoin's incredible cost of transaction. Now, this is one of the things. So when you're doing a transaction on Bitcoin, a lot of people don't know how much it costs. It's getting more expensive. And I think this is going to hurt the sentiment a little bit on it. Overall, of course, I am a bit of a Bitcoin maxi in terms of I think it's one of the better coins out there. Stood the test of time, has the ETFs, the Hong Kong ETFs. Obviously, no shorts allowed in that one. There's a lot of things that are going in the favor of Bitcoin right now. But one of the things that hasn't happened is we haven't really seen a really kick off to alt season. This does tend to be the time it happens. Microsoft looks like it's in distribution. My favorite company in the market's starting to fall off a cliff. And look, it's pretty normal. I mean, you saw a huge amount of trades up here. This is not the only position that we've had huge amounts of trades at, but it's kind of suggesting that Microsoft could fall further into the 370s and 380s. And you'll kind of think about that as a percentage. I feel like if Microsoft's going to get down to these levels, we could be looking at that 50-week moving average later on. So there's a lot of stocks that are right on their first buys, there's no doubt, but they also have that little bit of room to go if you're going to get to some of the big key levels, which end up being around that 47, 4,800 on the S&P. Also, what about the Bear Stocks Fund? Well, we saw some monster transactions on that recently as well. Turns out they were monster sellers and they just closed their position as of Friday close, suggesting there may be a little bit of an uptick because, of course, this is the direction against the market. So a little bit of an uptick on semiconductors maybe this week. I mean, that's a big dark pool transaction coming in right at the close. Also, look at this in terms of China. We had some big trades. So all of the China funds getting some possible inflows into them. In terms of the percentiles, some massive percentiles, some big rank trades, number 6 done over the last little period. And it's been a while since we've seen trades this big. So yeah, certainly looking good for potentially China bulls out there in the markets. Let's go through the general domination of markets, and you'll notice here that the Dow Jones and, of course, the Russell 2000 were not down anywhere near as much as the rest because this was driven mostly by semiconductors and big tech. The rest of the markets as well were pretty flat throughout the actual Friday trade, and you'll notice here that tech, semis, clean energy, communications, they were all down, while utilities, healthcare, some of the other markets like financials, retail, smaller financials, gold, all of these types of things were doing quite well. And the same story really goes for the last 5 days. A rotation out of big tech, which we expected, and a rotation into small little companies, and quite a few different companies here, including gold, which we've liked, and a lot of defensive markets as well that have been lagging for some time. Now, defensive move can tell you that there's more to come in terms of correction, so we'll have to watch on how the flows continue through for the week ahead. Let's jump into the charts. Let's take a look at the VIX. So VIX above 18, is that big? Yeah, it's pretty big, but above 20 would obviously be even a bigger deal for us. And that's where the bears really take control. And we saw our first look at 20 through the Friday trade, but we haven't held above this. So above 20, that's going to be a scalper or day trader's kind of paradise in terms of overall volatility. But I could see it kind of, if it gets below the 20 moving average on the weekly, it's going to spike big time. You're going to see a huge amount of vol come back into the market. But if we do get kind of that relief rally here, I could see the VIX coming back down a little bit. So it really depends on earnings, I would say, more than anything else. But maybe even markets, they do tend to be a little bit optimistic. Maybe they'll run a little bit into the earnings. We'll have to find out how it ends up trading through in the first Monday trade. What about our indicator on options? Well, you'll notice here that options have been spiking in terms of risk. First time we've seen that really since the beginning of 2024, and of course back in that September-October sell-off. So it continues to see spike. If this drops, market goes up and rallies. Again, it's a good sign that maybe the worst is over. We'll keep tracking that for everyone here. Treasuries, they're bouncing around the 61.8. Again, for investors, I think they're going to like this kind of level. And one of the main reasons is because we've hit that 5% on the US 2-year. But notice how it spiked back up. It looks like we're going to be higher for longer, and yields are getting close to where they were during those October lows. So a new high would be worthy of an alert this week, and that's going to be set just above 5%. So I think that's one that I'd be watching in terms of risk breakouts. Commodity index tracking still looks pretty good. Pullbacks are to be expected during this time, but as I've already shown in the previous video, go and have a look at that one. The commodities market could be set for a multi-year boom, especially if we get higher for longer rates for even longer than anyone expected. Dow Jones Transportation's average ended up managing to stabilize, as did home builders. So if we take a look at home builders, also some stabilization at these lows. This is an okay sign. We obviously look at the cause here. If home builders keep dropping off, and they did end up closing still on the low, so if they keep dropping off, that's not a great sign for market rallies. Again, could show us a dead cat bounce or that fake rally if we keep seeing it. So CTAs, some of these other leads could be worth watching. What about the US dollar? Often hedged during times of conflict or times of uncertainty. A pretty strong weekly close for the US dollar. It does suggest a little inkling that markets might want to be pushing a 108 narrative for the USD, and this is going to be a fairly big deal. I think I'd like to see more, maybe a new high this week, maybe break out a new high, 106.32, but US dollar still in a bull trend for now. Let's move over to copper. Strong break on copper. Very strong, I think. Looks towards the 465, 470 zone. So we've been bullish on copper for quite a few weeks. Zinc, metals, nickel, all those types of things. This is where a lot of the problems are in the world in terms of people need these rare earth minerals and metals. And at this stage, copper is working pretty bullishly. Let's move over to gold. Gold's still in an upward trend, barely holding on. You can see here the trend line going through the back of the lows. Still making a series of higher highs and higher lows. It's melting, or it's kind of like a dull market. So I'd be very careful about trying to go short on it. It is still in a bullish trend. It's still holding up, though it does seem to be weakening. We haven't seen the signs of a new low, such as a 2322. So I guess if it remains above this level here, the 2320, for now, gold is still on the bullish trend, and we do have big plans for it over the next 6 to 18 months. US oil, what's it doing? Well, it went up. It sold off that supply we spoke about in the last video. And it came back down. Not a great weekly close for it. Not a great daily close either. I can see why a buyer would buy here with stops below the low of 80. So I can totally see why someone would have a go at it. I think it's a bit unclear about its next move just because of the wicks and the way it's trading. But what's your opinion on oil? Is it going to bounce here, or is it going to weaken? It's in the buy zone territory at this stage, but that was a fairly strong rejection, showing that someone did want to sell up here. And remember, that's now 2 rejections. You've got one here and one here. You wipe those to the upside, get ready for the squeeze. So obviously some reaction here, levels worthwhile putting on your charts. New high at 86.20 and of course the 87.63 zone. Tesla keeps falling down. I wouldn't be surprised for it to gap fill into the earnings and then we'll find out the reaction of the market. Will it be a big bullish kind of candle, or is it going to be a big bearish candle exposing the 123? I think only the earnings will end up being able to do this. Remember, patience, react, don't predict. If you want to predict earnings, good luck to you. It's going to be a wild one, plus minus 10 plus, according to options. AAPL, that's been weakening. New close low, not great for the markets, obviously. Sometimes I call this a canary, but it has been weakening for quite some time. So it's no longer the leader in this market. Of course, Microsoft now being the biggest stock in the world. But when you have a look at it on the surface, it closed to a new low. It didn't show really any signs of strength. It could be exposing what we call a double top pattern, where effectively the market is projecting out that further sell-off. And if that did happen, 50-week moving average on the S&P is where we're coming from. I'm not going to sell Apple or buy it here. I'm probably looking for more than other things. But if you were looking at any particular side, I guess you'd be going the bear side. To sell Apple, though, is a very difficult trade in general. Selling decent companies, much harder than selling kind of crappy companies. So usually you want to sell crappy companies if you can. Semiconductors versus SPY. We've just hit the area that's always found the buyer so far, the 20 moving average on the weekly. Have a look at that. This is the combo. It just hit straight into it, closing right in its low. Now, whenever it closes on its low, it does suggest that there's more selling to come later on. That's only, it's maybe a 65% odds kind of stat there. So especially into a zone like this. So it's basically the first major buy the dip style zone for most semiconductor traders. And you'll notice that SMCI also, this is the one that fell off the most, 23.14%. That's a huge move. We're almost back now to the 61.8 of the last move. So this is where we kind of expect it. And I got to say, for a lot of viewers out there, we kind of talked about this over here. And this was our thought process, sideways to down over the next 3-month period. And that's exactly what has happened. Now, it's not to say, oh, yeah, we told you so or anything like that. Absolutely not. What we're just kind of pointing towards is that when you get these hyperactive markets and they go really ballistic and everything becomes speculation, when you see a crash off that speculation, often that is a time to see consolidation, a pullback in time, or a corrective period. And it's fairly likely that that was going to occur. And what often also happens is a second suck in. So you can see here the new high. And that's why if you're going to trade these positions, you're either really quick or use options, because you cannot have stop losses. If you have stop losses, you generally get wiped out. And that's exactly what SMCI did. Nvidia, everyone's favorite. Now, I asked a lot on X, a lot of people's reasons. Of course, there are some downgrades to chips in the future. There are, of course, geopolitical conflicts coming out in terms of why you guys thought this was selling off. There's just in general, they were overpriced. I think all of them are probably valid. In my opinion, one of the big ones was you had to hedge off the position coming into the close, which, as we know, there were quite a lot of strikes sitting around 840 on the options and 850 last week. Now, because they were there, and I don't think a lot of them were hedged, that forced a lot of shorting in the markets to get that clear done, and I think pressed it down. So that's part of it, and we do have a lot of options expiration on what was, of course, the OPEX. So I think it was a bit of an options reprice as well. Now, because we ended up going through our first buy the dip style zone without any structure, does that suggest there's further selling to come? Possibly. 680 obviously being an exceptionally good zone, I think, for Nvidia. But this is still where I could see many people liking the stock on the longer term projections. I will actually put out a video later on this week with some nice updates on what you're kind of looking at in terms of potential for Nvidia at current pricing. I think there's some okay upside still on this stock, even at these prices. Netflix, it's come down. It's dropped to a low. It's come back to the support we thought it might. It's not quite at the secondary gap fill. I would say that you don't have any reason to buy this stock yet other than just coming into the fill. There's no sign of strength. It closed near its low. It sold off. They're not giving subs anymore. That technically was the end of something like a World of Warcraft, just to give an example of subscribers when they stopped giving it to you, and it could continue to fall. So I think this is one that you'd want to watch. An example of something we looked at recently, which is, of course, Lululemon. You'll notice here, now that's on an uptick, and we alerted everyone. We liked this one last week in terms of the bullish side, but it got much worse before it got better. So you need to be able to pick your battles. Aussie 200 market now holding up thanks to, in general, metals, minerals, and financials being the main part of the market. this is where I expect kind of buyers to try to commit to the Aussie market. And the same thing's happening on the FTSE. Where the big surprises were, though, in some ways, were the Chinese market holding up pretty well, 0.51% up, not too bad. And then we also see here the German market with a huge, huge recovery. Wow, coming all the way back up to the first bull zone and closing basically a massive bullish hammer or pin bar. Is that a good sign? Well, someone certainly was a buyer, or at least it was oversold at one point. Weekly close, you notice here is a long leg doji, high, low, open close. Yeah, it's probably too early to tell yet. We didn't break any main structure. In fact, where the Eurozone trades ended up being, the France 40, the German 40, etc., were all at supply. So they're technically all at resistance coming into the week ahead. So it'd be interesting to see how these end up trading. Trade above 17.9, well, it's starting to look a lot more bullish on the charts. Let's move over now to the NASDAQ, another one that weakened, actually went through the first level. Obviously, it's below the weekly 20-moving average now. And if you didn't know this, again, the Qs or the NASDAQ are down against the tips this year so far. So have a look at that on the charts. January, so you can see here, January kind of the 1st, we're sitting at around 16.8. So we're only about 1% up for the year so far. So not a bad dip, not quite the epic dip that you might be looking for. I'd probably say somewhere around this structural low would be where I'd love to see the market go. But at this point, it's just going to depend on the S&P 500. I'm potentially buying the NASDAQ, but I'm not charting it as much as I'm going to chart the S&P, because I think the S&P is going to give you the best levels. It usually does. Ethereum market found a nice bounce, pretty strong off the bull zone number 1. And it looks like a lot of these markets, they especially the crypto markets, they just don't want to sell off. So you'll notice here it comes down here, hits like a number 8 on terms of overall sell, and then it bounces back up. Same thing happened on Bitcoin. I did tweet out about this. If it took this level and closed below, I really believed it was going to 52,000. If it did close, it just doesn't want to do it. Every time it comes down to these levels, even under the 63, it finds those little bit of a buying pressure. And at the moment, technically on the small time frames, the bulls are now in control. So if we go down to the smaller time frames, you'll notice here that we have a fairly strong kind of structural base that's starting to form. You do have some bullish intentions here on the markets, and it kind of looks like Bitcoin wants to hold up. I think it's a pretty volatile market. A hodler won't really care. Someone that's day trading, obviously they're going to be looking for down here to get into a very, very serious short. And in terms of the buys, I guess I would probably look at something like this, maybe as a possibility on the charts. One of the other markets I forgot to talk about a little bit was the Russell 2000. The only reason I want to bring the Russell up is it exemplifies the fact that Friday was not a sell across the board day, and that the market actually made it down to that 1920 level, which we quite like in terms of being where the buyers recommit. Now, if you're not familiar, the Russell's already experienced a pretty much full-on correction, 11% down, pretty serious stuff, coming back to a price that it was in January of 22. So yeah, certainly a sell-off there on the Russell, and it started to improve through the Friday session with a bullish hammer. So it probably needs to wipe off at least these highs up here to get serious about it, but it certainly is still key, and volume is absolutely accelerating during this sell, turning to the bullish side throughout the Friday trade. For the week ahead, there's a little bit of news. It's not just earnings, it's a kickoff of news. You can see the massive amounts of PMI data coming out throughout the world. Then we've got a couple of bank holidays as well coming in this week. And if we then scroll and keep going, you'll notice here that we have quite a few other things as well. So we've got the Bank of Japan coming out, core PCE, which is one of the Fed's kind of metrics. That's on Friday, April the 26th. So it's not just earnings, it's a kickoff of everything this week in terms of news around the world. So if you enjoyed today's video, guys, and you know how big this week is going to be, then make sure to subscribe and, of course, hit that bell icon, and also follow us on some of the other socials that we've got as well if you're interested. So much to go through, and this week is going to be massive. So let's get into it. Hopefully we can find some great opportunities. Bye for now.